Hello, listeners. Today, Ravi and Jam speak with Heiko Ludwig about the financing of renewable infrastructure. Heiko is the global head of structured finance at the German bank NordLB, experts in funding the energy transition. As part of the energy trilemma in this episode, money meets energy. And please, do not forget to subscribe if you aren't yet. Ravi, Jose, over to you.
Thank you, Ava, and welcome, Heiko, to the Unlocking the Energy Trilemma podcast.
Thanks for having me.
Yeah.
We welcome all our listeners to a new episode where we explore the complex balancing act between energy security, affordability, and sustainability. And today we dive deep into the world of project finance for renewable energy infrastructure at a time of profound change and uncertainty. So, Heiko, as we do with all our speakers, let me ask you the same question. What figure do you bring that is related with the energy trilemma?
I've thought about it long and I came up with a comparable, simple answer, a simple figure, which is 3. The reason I've chosen 3 is we believe that counting and adding all the future investments, net zero, the digital revolution, the investments in traditional conventional infrastructure, and nowadays the investments in things like defense and protection, we believe that in Europe, for example, the bank balance sheets, the way projects and infrastructure is funded today, bank balance sheets would have to triple. So number 3 is important for me because I think we need to accelerate the speed of recycling of bank capital by a factor 3 to avoid a scenario that would lead into an additional dilemma. Would you be optimistic that banks can and are wanted to triple in size? It's a very rough estimate, but it gives a good forward-looking context what the sheer size of those investments mean for the financial industry.
Mm-hmm. Do you believe that is an accurate statement even in the current context where we are seeing some divergence in investor expectations from renewable projects, especially after some kind of setback in the in views around sustainability, especially since the Trump administration came to power?
Yeah, I believe that in the medium to long term perspective, and I'm doing this activity financing renewable projects and sustainable infrastructure since more than 20 years with my team. We've seen a lot of setbacks at times, but also we've seen the return to the path. And I think it's very simplistic, the question, and I think agreement, climate change won't go away. There isn't a great alternative at sight. So I believe the political noise, if I may say so, at the moment is one of these moments where people might perceive it as a setback or slow down in terms of business activities on our end, financing activities, financing demand. I cannot confirm that the market has slowed down. There is I would call it the great compelling nature of reality, and that is an energy hungry world that has a long-term need for sustainability. That storyline hasn't changed. There is a lot of political noise. There's a lot of different voices, and in a plural world, I think it's important to have all these voices. However, I believe the long-term path is stable and clear. As such, the accuracy of the number is more, is it 3 times, 2.5, or even more than 3 times? I'm trying to be very careful with those estimates, but that the current way in Europe, for example, we are funding those projects from a banking perspective, and the future need for capital and the assumption that maybe this cannot only be done by banks, but needs a much more integrated kind of structure between bank and capital markets. I think that's absolutely solid. And as such, I would say accurate enough to have selected the simple number 3.
Do you see a shift in the type of investors entering the renewable space, and how does that affect the project finance structures?
I think if you compare, again, Europe to the US, there is just a very simple difference. I think in Europe, you have so many different markets, and every market has different type of investors. The German market, my home market, so to say, or the home market of our institution, is pretty much a high amount of medium, small, and some big players. In Europe, I would say we have probably around 100 clients plus. In the US, it's a much smaller number. And that also has to do with the sheer size of those developers, those investors. Projects in Europe tend to be smaller compared to the US. And then if you have very standardized markets, like, for example, Germany or France, there's space for smaller players. So for us, really, it's both. Yes, you have new entrants and new players that have to face the huge capital demand of those big projects. But at the same time, you have an industry that is in many parts represented by small, medium-sized firms.
In broad terms, Heiko, how would you define the typical evaluation process for shortlisting projects, especially when you have a wide variety of projects between Asia, Europe, and
Yeah.
North America? And what is the typical capital structure for these projects?
Yeah.
What is the equity participation from the developers, and what is typically the debt component?
Yeah, it's a good question, and there isn't one simple answer. From a selection process, the big one to always check, and which is the entry point for a bank to seriously look into a project to provide project finance, is that the project has to be ready to build. The process before the development process, that's not really for bank debt. That is development finance or finance that would then be provided by specialized providers who are happy to take on this kind of risk, mezzanine risk, or even more venture capital when it's new technologies. But you have to have a project ready to build, ready to be invested in. You need to have a clear idea about what kind of contracts on the technology side, on the construction side, and of course the offtake. So that provides the cash flow stability to a project. And as a bank, we usually faced with you asked that question before, what type of client, what's the nature of a client? A client could come in a very late stage of the financing process, like we often see in America, where those projects are almost already structured and the banks provide the final 20-30% of the structuring. And in other markets, it's a much more generic process where you are in a structuring phase with a client 6 to 12 months, because you'll help to achieve bankability. The project is ready to build, but those contracts are not yet fully negotiated. And you help the client to negotiate and structure those project contracts to make the project bankable. And as such, those contracts need to be bankable. So the short answer is it depends on client, market, and a period. The active period as a structuring bank of those projects can be 8, 9, 12 weeks, for example, in an advanced stage in the US, up to 12 months plus in markets where there is much more bankability structuring necessary, where the banks would, beside the MLA type of work, almost tend to do some kind of structuring and advisory to achieve this ultimate point of bankability, whilst the project still has already achieved its planning permission. It's ready to build. Yeah. And your second part of the question, if I remember correctly, what's the typical debt equity ratio? It really depends. A very kind of standardized type of project, for example, in the German market with a more stable tariff type of system that provides a lot of stability and a low level of risk, you can go to 85%, 90% debt. There's a lot of value, basically equity value sitting in the project approval, so to say. And other parts of the world where there's more risk in form of merchant or other components in the project's risk matrix can tend to be on lower gearing levels. I would say the average probably is around 70, 80%. Project finance usually is based on stable cash flows. And then you would find yourself 70, 80%, this kind of range.
And you mentioned, Heiko, countries such as Germany, and we have in Europe now a lot of hours with negative electricity prices, and the volatility has increased. What impact are these factors having on refinancing opportunities for renewable assets?
Yeah, I think the first part of the question, the problem of negative prices, and depending in what market you are, how is that negative pricing risk passed on to the project, and as such, part of the risk matrix for banks. It's very different. But what we see is, in my opinion, an effect of an focus on the production side over the last couple of years. So all these support regimes and the build out plans have really focused on production, offshore wind, PV. And in many markets, there's one very common theme: the transport of the energy been designed many decades ago for a much more centralized distribution. And that kind of activity has never been in balance with the increasing speed that we have witnessed on the production side. And I think it's like a traffic jam, and the risk that this negative pricing problem becomes bigger is one for the financing community as well, because of course there is a level which can be digested by the project and by the project cash flow buffer that inedible is built in to the structure. But it comes to a point where if this is not stopped and not countered, that the financing parties need to really make sure that they're not taking risk on that is actually not really for the senior debt side to take. But as I said, the renewables market is very diverse with many different market characteristics. And then the not so simple answer to your question is it depends where and with what kind of contracts.
What about production tax credits? Those are quite variable in different markets, and they're in some markets they're under some pressures. There is also talk about in some parts of the world they may not get renewed. How important are production tax credits or incentives when you evaluate the viability of the project or the bankability of the project?
I think if I may just start a little bit more general than the way a project is supported so that a stable cash flow and a stable low or considerable low level of risk to have project finance as a product, it really depends on the support regime. And in Europe, we tend to look into the production side that is supported. And of course, one of the great differences between Europe and the US is in the US, it's more of a tax-driven support regime, and your offtake contracts are much more private. Interestingly, and I come back to the beginning of our conversation, parts of those support elements can always change over time. And the best is they are phased. Something will go down or will disappear. Something else, another characteristic that makes your project financeable, bankable, is visible and is slowly introduced. So there isn't this kind of ad hoc change. Ad hoc and abrupt change is always bad for the industry and the financing activity over time. The worst is retroactive change. In terms of the political noise, it's very interesting. I call it the compelling nature of reality. There is an enormous need for energy in the US, for example, not just by the traditional industries, but their clear statement the US needs to be the leader of the tech side of the world, whether this is intelligence or anything that is within this tech space. And for example, data centers need an enormous amount of extra energy over the next couple of years. People estimate it to be around 415 terawatts, changing or increasing to 945, so doubling in the size, doubling in the volume just until the end of this decade. And that's the nature of reality. Somewhere this energy has to come from. And it's interesting, the question around the tax credit or the change of the IRA, which is the overall system this is all embedded in, it's almost sounding like the phasing of that, it's beyond the term of the current administration. It almost sounds like somebody has admitted that this problem is a bit more complex than just saying we don't like this type of support for this type of industry or this type of energy production. And I think the reality check really is that whilst we might not like it, we need the energy. And there's only so much you can build in a limited amount of time. To order a new gas turbine, the industry experts would be able to answer it much better than me, but I've heard something like 3 years plus. You can build a gigawatt of PV extra capacity within 12 months, roughly. So, if there's an extra demand for energy, there's only so much you can do. And you can only go renewable at the moment, short term. So it seems, yes, political noise and questions around what is available, what type of support will we continue to see. And if I try to see what's happening in real life in terms of demand and projects we are asked to finance, the pipeline at the moment looks as strong as we've seen it in 2024. So it's this kind of interface between political noise and the reality, what's really going on in the market.
And just as a follow up to that, are you seeing any divergence or convergence around investor expectations between US and Europe? Do you see any change?
No, I think we've seen some of the US investors coming into Europe. I think there are some new markets that they have been able to invest in earlier. For example, battery storage. Clearly, this has started as a level of activity, building battery storage, whether co-located or whether standalone in the US 5-6 years down the line. And we have financed those projects. We're eagerly waiting. When will this arrive to a larger extent in Europe, which has happened in the last 12 months, so to say.
And Heiko, you have mentioned politics and energy, and there is a very good example in Europe with the European Hydrogen Bank. Do you think that this, let's say, proposal is something that will help the development of a specific sector like the hydrogen? You belong to a bank. Do you think this is a fair competition? Is a complement to you? What do you think about this tool?
I think it's a complement. We always had development, multilateral activities alongside the commercial lenders. And I think it goes hand in hand. I think I prefer them on the new technologies. I not necessarily think it's helpful if they take away credit capacity where the overall commercial market has that capacity. But anything that needs support, anything that needs this stamp, if I may say, that somebody with a multilateral background supports and is as a risk taker on board as well, is very helpful. And I think you mentioned hydrogen. I think what we now have learned is that after the start of the tragic war in Ukraine and the European dilemma to where do we get our energy from and how quickly can we build our own source, yeah? I think what we've now witnessed is that it's just not going as fast as initially hoped for. Technology, cost. But I have seen some very promising first projects. Yeah, I've just recently been in Denmark at a fantastic project opening where there is a PV source, there is a hydrogen production plant, and they take CO2 from a biomass plant and produce e-fuels. Yeah, we need more of these, but these projects need strong contracts and they need the support as wind and PV got that support 20 years ago. And I think that shifting the support to the new technologies that also will buy into and will help to create this path towards net zero is very important. But it's hard to do, right? Because you've established the support, the whole community gets used to it, and it's very hard to shift it. It needs to be phased. It needs this longer term plan. It's a challenge. It's a dilemma. Yeah, you take something away and give it to another activity that never goes without certain forces pulling against it.
Perfect. Heiko, thank you very much for all this conversation, and let us close it with a common question to all our guest speakers. If you had a magic wand to unlock the energy trilemma, what would you do with it?
I would like to stay in the financing dimension. And I think one of the features that would really help to unlock it from a financial markets point of view is if in Europe we can create something like a more integrated capital market. Coming back to my magic number of 3, if we have a better integrated bank and investor world, we could increase the turnover of financings a little bit like the US. And we have to say, they do that more successfully because it's faster. We could unlock this extra force by shortening the amount of time bank debt is employed for a project. When the project is largely de-risked, then we can get institutional investor money and capital into those projects and employ the bank debt where most needed or where there is need thinking of all these additional investments coming our way. So I would really think that more integrated, maybe not perfectly integrated, but a more integrated capital market system would really help Europe to unlock the extra power to solve this trilemma.
Fantastic. Thank you very much, Heiko.
Pleasure.
And let's keep in touch. We'll follow you in the media.
Thank you very much. And
Thank you,
for having
Heiko.
me.
Thanks for coming over. Thank you.
We hope you liked this conversation. Follow us on LinkedIn or subscribe for free to the podcast on the platform of your choice, Spotify, Amazon, YouTube, or Apple. Because in the next episode, Ravi and Jam will speak with another expert in the industry to unlock the energy trilemma.